Well, for more on black gold, we're joined here in the studio by London-based French financial analyst and investor Yannick Naud. Thank you many for joining us. As we heard in that package there, the oil price down around levels we've not seen in some 6 years or something. What is behind this drop?
Well, first of all, you have to keep in mind that the commodity market as a whole is very weak. I think the commodity index is at 9 years low when the oil is at 6 years low. I think it's a combination of different things. We probably will see some interest rate hike from the Fed next week. And historically speaking, when the Fed starts to increase interest rate, the dollar gets stronger and commodity price, including gold, is getting weaker. This is the first factor. Second factor, we have seen pretty bad economic number coming from China, which was the factor of the growth of the market in the last 10 years, I would say. Iran will be exporting again because we still think that sanction will be moved, and therefore it could be a large player in the oil market. So all of these factors, plus the fact that the OPEC is keeping production pretty high, is putting a lot of pressure on oil price.
Well, let's just pick up on OPEC there, because Saudi Arabia is obviously leading the charge as far as the policy decisions are concerned, and it is perhaps in the best position to stick to its guns when it comes to maintaining supply while prices are so low. So how are the more vulnerable exporters, people like Nigeria and Venezuela? Venezuela is obviously the one with the largest proven reserves as well. How are they going to fare in that?
Well, as you said, the OPEC production is stable between 41.5 to 32.5 million barrels a day. I think it's important to look at two things. What is the cost of extracting oil? And most of OPEC member can extract oil at much lower level than the Shell or BP, for example. But a lot of them rely on oil to balance the budget. So it's very important to look at what I will call the budget break-even. And every country rely on a certain oil price. For Saudi Arabia, if the oil price is under $105, so much higher than current prices, they will run a deficit. For Venezuela, or for example, Nigeria, it's probably closer to $120. So as you see, all those countries, I think the lowest country is Qatar, it's $80. So every OPEC and non-OPEC producing country will run a deficit because of the lower dollar price, the oil price. Obviously, Saudi Arabia have extremely large foreign reserve. I think it's still at 3 year low. In September, I think it was $647 billion. It's 3 years old, but it's a lot of money. So they will be able to either issue bonds or just reduce the reserve. Some country with debt and with lower reserve, like Venezuela, for example, will suffer.
Let's take a look now at sort of the impact we're seeing on the European markets. It's certainly weighing heavily there. How are you viewing this?
Well, obviously, within the European market, there is energy-related or commodity-related company, whatever it's oil or mining or even renewable, and all those companies will suffer, obviously. Having said that, for the consumer, it is a good news. In Europe, we're in a situation where the European Central Bank will continue quantitative easing. The euro is likely to get lower, and the consumer will spend less on oil and every commodity. So all in all, it should be better for the consumer, and therefore for stock market, it should be better for stock like automobile, for example, media, construction. And I think because the anticipation in terms of growth and the expectation in Europe are still very, very low compared to the US or other country, we might have some positive surprise, in fact.
All right, Yannick, well, we'll leave it there and we'll keep watching those prices.
Thank you.